It's 9 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills, and this is Yahoo Finance Live. Here's what we're watching this morning. Well, fresh jobs data out, private payrolls beating the street's expectations. Employers adding 164,000 jobs in December. This is according to the latest ADP report, driven by a bump in leisure and hospitality. The numbers once again signaling a resilient labor market as investors look ahead to tomorrow's jobs report.
And another downgrade coming in for Apple. Analysts at Piper Sandler cutting Apple to neutral from overweight. They're citing growing concerns for the tech giant's iPhone sales and inventory levels. And Piper Sandler is now the second investment firm to downgrade Apple stock so far this week.
And Walgreens churning out better than expected earnings results, beating the street's expectations on both the top and bottom lines. The company also announcing a dividend cut, its first in nearly 5 decades, in an effort to strengthen its cash position and balance sheet. Let's get to our top story of the day, and that is the latest look that we're getting here at the jobs market. ADP report released just minutes ago showing that private payrolls added 164,000 jobs in the month of December. The big driver here, one of the big drivers, I should say, is leisure and hospitality. We certainly did see services once again leading the way. Education also amid that mix, adding 155,000 jobs when you take into account education and hospitality together here in Maddie. But once again, this report really pointing to the fact that we have a resilient labor market beating the street's expectations. As we look ahead, though, to tomorrow, we know the ADP report not so much too reliable in terms of what we could get tomorrow, but once again showing that companies are out there hiring and people who are looking for work, a lot of times are able to find those jobs given the fact that we have seen such strong growth over the last several months.
And that growth, maybe a little bit of stalling there for wages, but not a ton. However, it might be enough to make the street happy, with wage growth coming in at 5.4%, down from 5.6%. That might be a little bit of something that the market can cling to shrug off some of this data, seeing a little bit of green in the futures pricing here. Having said that, yields also moving ever so slightly here. You can see the Dow up just a touch here, and the other indices kind of floating around unchanged. The Nasdaq down, probably off of that Apple news more so, but seeing those yields rising as the ADP report did beat estimates there, and that could be something that continues to dominate the yield space today off of that jobs data this morning. Shauna?
Yeah, certainly. And it's interesting to see what the reaction is going to be. And then, of course, just in terms of what we are going to see tomorrow, because we're expecting to see just a bit of cooling there. But again, the consensus estimate last time I looked was right around 170,000 for tomorrow. So we'll see whether or not that comes in better than expected.
Yep, lots of jobs data this week. But the higher than expected private payrolls report this morning was accompanied by initial jobless claims coming in lower than expected for the week ending December 30th. So the big question, of course, is the labor market still too hot? Joining us now, Joe Brusuelis, RSM Chief Economist. And Joe, great to have you on. I'm just curious, how does the market continue to price in 6 cuts after this data this morning?
Well, the market's going to pull back. It's a little bit over its skis. The bond market's overbought right now, so rates, the long end's going to go up. Look, when you take a look at this morning's data, you mentioned resilient. I like that word, right? Because my theme for last year was resilience, not recession. Okay, so what are we seeing here? A labor market that's broadly cooling. The acyclical sectors, what you want to see, meds and eds, healthcare, education, social assistance. We see hiring there as the market pivots and the economy pivots to a little bit of a slower pace of growth in the first half of this year. I liked what I saw. You know, you mentioned the wage growth, right? So let's say that's your metric, 5.4% on a nominal basis. Once you back out inflation, let's say 3%, what's that tell you? You get 2.4% increase in real wages. That's what's going to continue to propel this economy, even as some areas continue to have some problems. Obviously, manufacturing hasn't quite gotten out of it, although we know, because we can see all those factories that are being built, that's going to be a second half story. And of course, the problem's in real estate right now, right? But nevertheless, the consumer is hanging in there in a very solid fashion, and hiring is just going to continue to do better. Tomorrow, I expect 135. Now, that's below the consensus of 170, but that has to do with the difficult seasonal adjustments around retail, warehousing, and transportation. Normally, say 10 or 20 years ago, you would have seen a big jump in December on those. Not so much this year.
So, Joe, how do you think the Fed is potentially, not so much that they're examining this number, but if they look ahead to tomorrow, if we do see 135 like you're expecting, even if we do see 170, which seems to be consensus right now on the street. Is that still a bit too hot given the fact that that last leg, the last mile here in this fight against inflation could prove to be much stickier, much trickier than maybe we had initially anticipated?
So if you're a central banker, you're looking at, well, if they get say anywhere between 135 and 170, you're going to end up with 2.7 million jobs created last year. Big smile on the Fed's face. Second, they do think that disinflation is moving through the economy at a slow pace. That will create the condition for a decline in the federal funds policy rate, simply because at 5.5 on the upper boundary, it's too restrictive for an economy that's likely to move back towards a 2% trend growth rate this year.
So where do we look in the data for clarity, at least from the market's perspective? Because I'm seeing a lot of unchanged action and maybe a bit of confusion about what to do off of this data.
Well, so if you're a forward-looking investor, right? What you're looking at probably is more the inflation aggregates and some of the metrics that you can pull out of that, rather than backward-looking hiring data. So if you're a forward-looking investor and you're trying to estimate where policy is going to go, you're going to be looking at housing, where the inflation rate's moving there. And then, really you want to see services inflation begin to abate. That's not exactly where the Fed wants it to be, which is why in that minutes yesterday, they said rates are going to remain restrictive for some time, even as they're creating the conditions to reduce rates later this year. And by the way, ladies, if you're an investor, I want to pull one big thing out of that report, that Fed minutes report. They're creating the conditions whereby they're going to end quantitative tightening, likely later this year or early next year. That was really overlooked yesterday afternoon. I was on the airplane coming in and I read through the minutes and I thought, okay, this is it. Boy, and it doesn't matter what asset class you're in.
Did the market miss that?
They missed the market, completely missed that, because if QT is going to end, that's going to result in an improvement in liquidity conditions, and that helps everybody across all asset classes. That's, if you're going to be bullish, that's what you want to hang your hat on right now.
So then is the market maybe not too optimistic just in terms of the outcome that we could see given policy moves from the Fed? Yes, maybe they're too optimistic in pricing in 6 rate cuts for this year, but given the fact that we could see an end here to quantitative easing, maybe there is a reason to be this optimistic at this point.
So traditionally, when the Fed reaches its peak in its rate cycle, you see an increase in the equity valuations of 20 to 30%. We're already there. I think that the market got this portion of it right now, the 6 rate cuts. No, I think maybe 4 rate cuts this year. That would make sense to me, just given, because rates are just too restrictive for where the economy is and where it's likely to go. But 6 rate cuts, a little bit too giddy for me.
When do you think we'll see the first?
June.
And last time we had you on, you said this is what soft landing looks like.
right.
Is that still your base case?
Yes, that's our base case forecast for the year. And look, I think the major takeaway when we get through tomorrow morning at 8:30, the pandemic era in terms of the labor market's now behind us. We're now at the new normal. That's something to celebrate. And then that's also going to be the main lift for all of the investors out there, all the economists, all the strategists, which is, how are we going to define this new post-pandemic era economy that we're now living in? What's going to be the driver, and then where are the risks? Obviously, we can turn on the news this morning, look at what's going on in the Eastern Mediterranean and figure out where the risks are, right? But those growth drivers, well, that's still, up for discussion. I think it's a very resilient consumer household bolstered by rising real incomes. That's, to me, is going to be the story here this year.
All right, Joe Bruce Boyle, it's always great to get your insight. Thanks so much for having on set here with us this morning. Always great to talk to you. All right, well, another big story that we're following today, Walgreens shares falling here in pre-market trading off just about 2.5%. The company reporting its fiscal first quarter results. Now, the pharmacy retailer beating the street's expectations on both the top and bottom lines. $36.7 billion in revenue, adjusted earnings of 66 cents per share. The company also reiterating its full year earnings guidance, but they did slash our dividend by almost 50% to 25 cents a share in an attempt to strengthen its balance sheet and cash position. We want to bring Yahoo Finance health reporter Anjali Kamlani, who spoke to Walgreens CEO Tim Wentworth about these earnings results last night. And Anj, what did you learn there?
Well, I would say that newly installed CEO Tim Wentworth is pretty optimistic about the future of the company, looking at maintaining a focus on the front line, on the front stores, front of the stores, back of the stores, on the stores in general, really. And that's different than what we heard as rumors and what, the street was really speculating and what analysts were speculating could happen with his background in insurance. And so he was pretty emphatic about the point that the company isn't really looking to get into insurance. Here's what he had to say.
I do not want to write insurance. I don't know why we would do that. But I also don't want to turn away from the store. I think one of the mistakes in the narrative has been that we are going to or are turned away from the store. I actually think it's different. I think what we have to do is use the store as the point of engagement that it represents. Our 85,000 people in the back of the store that touch people on their health care, forget the front of the store for a moment. We got to figure the front of the store out. Don't get me wrong. And there's lots of things that are underway to look at optimizing that floor space and that workforce. But at the back of the store, the trust that we can build is going to enable a health services company.
So as you can hear, they're looking at it as really focusing on that pharmacy point of view and not kind of following suit of CVS, which was, acquiring Aetna and then focusing on healthcare services. He did specifically say that the investment in VillageMD was going to be more of a bottom line rather than a top line benefit. So I thought that was kind of interesting. But starting out with the first, earnings for Wentworth, it's going to be interesting to see how he pans that out and how the strategy comes to fruition.
I know you also talked to him about Boots, and I feel like Boots has been this kind of ghost over their shoulder for a long time. Yeah. What did he have to say about that? That's
right. Yeah, we also heard the rumors, of course, that they were looking to offload it. That's something that they tried 2 years ago when the market wasn't as strong. But he did say that everything's on the table. That's really what he said. They haven't necessarily made a decision just yet. And here's what he had to say about the full thing.
Everything is on the table, and hopefully with the dividend decision, you see that the board is supporting me and my team to make difficult decisions that maybe in the past, weren't deemed to be something that you would expect. Boots is one of our assets that is performing really well, and the question that we are, always going to ask about that, as well as other assets, is this the best way to create shareholder value by holding on to Boots and having it be an earnings driver? Or can we unlock focus in the U.S. as well as opportunity for more growth for Boots by looking at something else?
So basically, the company is looking at whether it should be a U.S. only or a U.S. focused company rather than split between the U.K. and U.S. And with the cut in dividend, with beating the street, it certainly is an interesting picture for the company right now.
Anjali, great recap on those earnings and congrats on the conversation. Really appreciate you bringing that to us this morning. Now we're going to move on to some market moves because Apple not catching a break this week. Piper Sandler hitting the iPhone maker with another downgrade, cutting its rating from overweight to neutral. This is the second one for the tech giant since the start of the new year. Apple shares falling today, potentially weighing down some of the indices. Jared Blickery is at our Interactive watching the moves. Jared, what's that Apple movement doing today?
Well, we're seeing some more downdrafts. I'll check on the overnight in a little bit, but you can see Apple down here 4.3% this year, and that's only 2 trading days. Let me put those pre-market quotes so we can see how much this is affecting. Down another 1%. So we're looking at year-to-date down about 5% on the open here. Some notes from Kumar. He's saying difficult comps from 2023. This is going to be paired with constant currency headwinds. They're expected to continue into the first half of this year, 2024, with interest rates remaining elevated. So that just shows you how far the Fed reach into the market goes right now. Apple, a huge bellwether stock, the largest market cap in the entire world, really getting hit on the chin at the beginning of the year. And this is kind of reminiscent of what happened last year. Here's another quote from our analyst over at Piper Sandler. We are concerned about handset inventories. Growth rates have probably peaked for unit sales, and those growth rates, you take a look at revenue growth overall, that peaked at about 50% on a quarterly basis year over year in 2021. But the last time we've had what's expected now, 4 quarters of revenue growth shrinkage, the last time we saw that was 2001, and that was in the midst of the 2001 dot-com bust. Now, here's another one. This is a Barclays analyst. We were talking about what happened Tuesday. They said the iPhone 15 has been lackluster, and we believe iPhone 16 should be the same. So Overall, Barclays downgraded to underweight, so that's actually a negative. That's equivalent to a sell rating. The Piper action today makes it neutral. They do have a price target of 205. I should note that. That is above 184.25. That's where it closed yesterday, and that is well above the all-time high, which is just sitting under $200 a share. But you take a look at what's happened here. This is potentially a double top. So that's the technical breakdown that I'm reading a lot of people on Twitter and I should say X now. But that whole discussion really encapsulated here as we can see a potential double top in the making. One final point. I just want to point out how dismal tech has done this year. It was a leader last year. XLK down 3.6%. And here's one more chart for you. I'm going to show a 5-year chart, and you can see how we have this new nominal high. This is an all-time high right now, but it looks like we are about to sink below this breakout line. If we sink below by, what is that, about 170 or so, that presents a much bigger problem for the tech sector, and Apple being the most important in that weight. Of course, we're going to be watching for further developments with respect to that stock.
We certainly will. All right, Jared, thanks so much. Nasdaq 100 looks like might start the day here under a bit of pressure, which would put it on track for its 5th day of declines. Jared Blickery, always great stuff. Thanks so much. Okay, right here on Yahoo Finance, we got much more of your market action ahead. We'll be right back. Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
And actionable information about your investments.
We bring you the opening bell on Wall Street.
And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
All right, we are about 10 minutes here until the opening bell on Wall Street. Let's take a look at some of the trending tickers here on our site this morning. First up, we got to take a look at microchip technology because chip stocks are on the move after President Biden is doubling down on chip funding, announcing a $162 million investment in microchip technology to expand factories in Colorado and in Oregon. Now, this is the second round of funding from the Biden administration since the CHIP Act went into effect back in 2022. Now, this is the first round of funding for microchip technology. It's important to point out that that first award went to BAE Systems just last month. But Maddie, when you take into account what's happening here, obviously the Biden administration really placing an emphasis on bringing this manufacturing for chips back into the U.S., focusing on national security. And for microchip, this funding will be for chips and will be for MCUs, which is really key to both consumer industries, but also defense industry as well.
Right, exactly. It's not the typical chip conversation that we talk about a lot, where it's an AI-driven play here. What I think is interesting is the thinking on who the Biden administration selects for this funding. And we know that this name had already talked about building up these fabs for chip production back in February. So they were already at this work, which is really critical because this money can take a long time to get to these firms. We've heard that complaint from the previous funders that received this money, and it could take up to 5 years for these factories to even get up and running. But having said that, 700 jobs created and lots of potential chip production as well, which could be really important to future-proof the U.S.
Yeah, certainly. And we've heard from Commerce Secretary Gina Raimondo that they plan to award more of these types of funding here going forward, saying that we should expect to make about a dozen semiconductor chip funding awards here in 2024. So this is the first.
This is the first. And along with that, I also want to pivot a little bit, talk about Novo Nordisk signing a $1.1 billion obesity R&D deal with two biotech companies, the drug maker announcing those partnerships, and those agreements will aid in the company's developments of treatments for a liver disease known as MASH and, of course, obesity. Now, it's interesting to see these deals already taking place when we've had a lot of guests on our show talk about how these partnerships and deals are going to continue this year, and biotech and pharmaceuticals are going to have a lot of deal making and partnerships this year. You can see the street rewarding these names in the futures trade this morning, 8 minutes ahead of the open here. Novo Nordisk up 1.5% off of this news, and this morning it was up 2.9% following this news as well. Shauna, so seeing a reward there.
It is. We certainly have seen the street very encouraged by Wegovy, by Novo Nordisk investment in this space, in the weight loss space here in the past. Clearly, Yahoo Finance's Company of the Year for 2023, given the massive run-up that we did see in shares last year, up just about 50%. But this investment and why we are seeing Novo Nordisk once again trade in the green is really, this is just doubling down and a bet here on the future pipeline of drugs, experimental pipeline that they have. So to hopefully here maintain their lead that they do have up until this point, it looks like, in this very fast-growing market of obesity drugs. So again, making this investment in these two companies, we'll see how this all plays out. But again, Omega Therapeutics and Celerity. Let's take a look at another trender here on our radar, and that is Microsoft hitting a Control-Shift AI on its computer keyboards. The tech giant adding an AI feature called the Copilot key to its Windows 11 PCs, which will allow consumers to have text conversations with a virtual assistant. Now, Microsoft calling this the biggest change to its Windows PC keyboard in nearly 3 decades. We know Microsoft, obviously closely linked with their investment in OpenAI, has really helped to propel the stocks over the last 12 months, propel shares over the last 12 months. We'll hear a little bit more about this at CES next week. We're expecting to get some demos. We're expecting to get a little bit more info on how exactly this is going to play out and the impact that this is going to have on Microsoft's hardware partners there at CES next week. But clearly, this shows Microsoft further investing in AI, or I should say incorporating AI into their hardware products, and could really set them apart, obviously, from some of their competitors.
Yeah, I wonder if it's the first indication of how hardware and the AI software is going to come together, because we know that the AI-powered phones are something that's really heavily anticipated. Is this our first kind of clue at what that might start to look like? It's interesting to see. We're going to have all your markets action ahead right here on Yahoo Finance, so stay tuned for more.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street.
And don't miss our strategy sessions with Wall Street's top analysts.
It's the morning brief.
It's the morning brief.
The morning brief.
Yahoo Finance's morning brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
We're here in Las Vegas, Nevada, outside of the Sphere. It's the massive music and entertainment venue that opened a few months ago. But the real reason we're in Sin City is for CES 2024. It's one of the largest tech shows on Earth, and we're going to be bringing you all of the news, innovations, and ideas out of...
Hey, Howie, hold on. We're not in Vegas, man. We're still in New York. And that's not the Sphere. It's a cube.
I'm going to miss my flight. Oh, taxi! Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas.
All right, we are hearing the opening bell on Wall Street this morning. I'm going to walk you through some of the market action that we're seeing. I'm going to start global here because we're still seeing a little bit of weakness over in China. That's following some negative economic data pointing to a still weaker than expected recovery. The CSI 300 down by about 1% in the early morning trade today. Seeing a little bit of positivity over in Germany that was following a less than terrible CPI print out of there. Now, having said that, let's get to the U.S. here. We're seeing the S&P 500 down just about 0.1%, the Nasdaq down 0.4%, and the Dow Jones Industrial up a little bit. I want to take a look at the Russell, actually starting to get into the green on the open this morning, having their worst day ever since the banking crisis on the close yesterday. So interesting to see a little bit of positivity there, but still down over the past couple of days. We're going to talk about that with a guest that we have coming on our show a little bit later on, and what's going on in the small cap trade, given that it's supposed to be doing well this time of year, but we're not necessarily seeing that so far in the trade. I want to get to some of the broader indices here. Again, seeing that positivity in the Dow Jones, still seeing a little bit of red on your screen. The S&P kind of sloughing off that jobs data from this morning, not really sure what to do with it. The Nasdaq likely being pulled down by that Apple downgrade, the second one that we've seen this week, guys. But interesting to see what the entire market move is trying to do, given the confusion about that labor data, Shauna.
It certainly is. All right, Maddie, let's send it over to Jared Blickery standing by in the newsroom with a closer look at more of the action that we're seeing at the open, Jared.
Yes, I think first and foremost, I got to recap what happened yesterday at the close. That was the end of the Santa Claus rally, a 7-day period, 5 days from the last year, the first 2 of this year, trading days only, and that ended in the red. And so when we compare that to the returns at the end of January, if January is ending red too, along with one indicator, well, that portends potential weakness into the end of the year. And I realize we're only 3 days into the new year in terms of trading. But I want to check in on the 10-year T-note yield. We have seen yields actually popping the last few days, and this has put stocks under pressure. You can see here's a 3-month chart, and we are coming off of the lows that we saw in late December. And another thing I've been looking at is the strengthening U.S. dollar. It's down just marginally today, but that's after 2 strong days of strengthening. Another headwind against a lot of the growth stocks that have kind of come in favor over the last year. Now, here's a 5-day look at the sector action. We can see utilities and healthcare. Those are the 2 leading. That is defensive. And let's dial it down to see what's happening intraday today. Energy is in the forefront. That's up 1%, followed by financials and industrials, then healthcare. So it looks like the value and cyclical sector is doing best today. What is not doing well? Tech. That is down. XLK down 1/3%. Consumer discretionary, that's retail, also down about 1/4%. And of course, we want to check in on the Nasdaq 100. I was reviewing that downgrade by Piper on Apple just a few minutes ago. Apple down another 1%. And let's just take a look at a 10-day chart. You can see it's been down about 7%. And if I broaden this out to a 1 year, you can see this pattern I was noting just a few minutes ago, the potential double top here. So we'll have to see how this plays out. But Apple, a huge bellwether again for the market.
All right, Jared, thanks so much. Let's talk a little bit more about some of the selling action that we have been seeing over the last couple of days, because the Nasdaq struggling to recover once again this morning after a rough start to the year. 2 Apple downgrades weighing on the Nasdaq 100. It is on track for its 5th day of decline. Yahoo Finance's Josh Schaefer is here to discuss. And Josh, when you break down some of the action that we've seen since the start of the year, coming in, a handful of strategists were very bullish on some of the trading action that we could see play out this year. But we did have some bears. Is this a sign that maybe the bears were onto something, or a bit too early at this point?
Well, it's definitely too early, right? But I sort of spent the morning and a little bit of the afternoon yesterday just figuring out why we are down to start the year, right? And asking some folks that and sort of trying to reason with it. One research note that I was taking a look at from Capital Economics was interesting to highlight. They sort of point out 3 basic reasons why we're down to start the year. One of those reasons essentially being from Capital that they see what they see right now is essentially after the rally, a period of consolidation is something that's normally happening, right? We had a big rally from November and December, right? It is not abnormal to see a little bit of selling after that. They also highlight that risks may look less attractive than they were in December because we've now had that shift, right? We sort of had the soft landing trade take place more or less in December. So now if you're not still feeling, the euphoria of a March rate cut, maybe you're not as likely to just keep buying small caps, right? They can't go up forever at some point. They also highlight disruptions in the Red Sea, Maddie, which I know you were talking about a little bit yesterday, how that could impact supply chain. I would put that as probably one of the highest risks there that you could see maybe playing out for multiple months. But I think when you combine those together, the takeaway is it's macro driving the market, right? And if you really look at what a lot of the bulls said coming into 24, they want fundamentals and earnings to drive the market, right? And that was something that Oh-Sung Kwang highlighted to me. He's over at Bank of America. He said, hey, we're still constructive on equities. We see the S&P 500 hitting 5,100 to end the year. Let's wait for earnings to come. That's what's going to drive stocks. It's not about macro and still talking about the Fed and arguing those points.
And that makes sense given what we've seen with Apple, that it's a fundamental story potentially driving some of that consolidation versus some of that more macro commentary. Steve Sosnick yesterday said that we had sizzle towards the end of the year. Now we got to see if the steak is any good. Is that a sentiment that you're starting to hear in your reporting too, Josh, that we're just going to see if that euphoria made sense this year?
Yeah, well, and we need to check the steak again with earnings, right? That's the big question here is like we already kind of had the trade that we could have had to start January in December. And I think that's something when you ask a lot of strategists that question, people are sort of agreeing with that. Maybe the 2024 rally came a little bit early to end 23. And now you sort of sit in a 2-week period where all we can do is read too much into a Fed meeting from last month and find one word that might mean that they're not going to cut and read too far into some of these things. And I think we're in a little bit of that period right now in the market where we're maybe just looking too far into it and overthinking.
A lot of focus on
we like to overthink
too.
Though. It's fun.
Right. What else?
Keeps things interesting.
This time.
Yeah. All right, Josh, thank you so much. We really appreciate you joining us on all things market commentary. Now, the January effect is in hiding right now. Typically, small caps doing well in the first month of the year, but we're not really seeing that this week. The Russell 2000 closing at its lowest level since the banking crisis on Wednesday. Our next guest, though, thinks that despite the rocky start, small caps have the potential to outperform some of those larger cap names. So for more on this, we're going to turn to Jonathan Boyer, Boyer Research President. Jonathan, thank you so much for being here. I'm just curious, what do you think is the single biggest driver of the movement that we're seeing in small caps right now, given that the technicals tend to tell us it's going to be a good time for them?
First, thank you for having me and Happy New Year. Yeah, I mean, listen, the last couple of weeks, we look at things on a longer term basis. We had a great last quarter to end the year. We're only a couple trading days into the year. I wouldn't analyze that too much. But each year we come out with something called our Forgotten 40, which is our 40 best ideas for the year ahead that have shorter term catalysts. And I think it's telling this year that 19 of the 40 names have market caps of less than 10 billion, and many are significantly less than 5 billion. So that's where I think a lot of the action is going to be. Small caps have underperformed significantly since 2015, 2016 by about 6% a year compared to the S&P 500. So regardless of how well the Russell might have done to end the year, there's a lot of catching up to do if you go back to historical norms.
Yeah, when you take a look at some of those individual names that have been underperforming the broader market here for quite some time, drilling down to the fundamentals, what are some of the common themes or common areas that you're looking for when you're trying to identify the most opportunistic or where you're finding the most opportunity at this point?
Well, small caps, by the nature of them being small and underfollowed, is where we can find the most value. So you look for hidden assets, things that aren't properly reflected on a balance sheet. For example, one of the companies that was in this year's Forgotten 40 is IAC. They own a stake in something called Toro, which is a ride-sharing app. It's basically the Airbnb for car sharing. And they own a 30% stake in it. It's on their balance sheet for about $300 million. It's probably worth triple that. And on a $5 billion company, that is significant. So that's the things that we look for, these hidden assets, things that other people aren't looking for.
Well, I know that you also have MSGS as one of your picks, but when you think about both of these names, what's the most important thing that you can look at to find that? I know you do this professionally, but for our retail investors who can't have the luxury of doing this all day, every day, where can they look on the balance sheet to determine some of those edges?
it's just reading. It's just spending your time looking for these things. You have to look at the entire balance sheet. You have to look and see what's on it. See if there's anything that just doesn't make sense. Do they have buildings on there that are at below that are at crazily low valuations because they were bought many years ago? So it's just a case-by-case basis. There's no magic formula. It's just doing your homework. But individual investors can certainly do that at home.
Jonathan, what do you think is going to take for the markets to stabilize here? I know you led off by saying you don't want to read too much into a couple of days trading action, but a lot of investors have been looking at the losses that we have been seeing over the last couple of days and are getting a bit worried. When do you expect that to stabilize a bit?
That's the billion-dollar question. I have no idea. There's a lot to worry about. Who knows what's going on? Will happen in the Middle East. We do have an election this year, which is going to might cause some issues. But there's always reasons not to invest in the stock market. You can always scare yourself into saying something terrible is going to happen. But over the long run, if you buy undervalued stocks and hold on to them for long periods of time, generally good things happen.
We've talked fundamentals and now macro. I want to go technicals with you for a second on the Russell, because the Russell hitting the 21-day moving average and a trend line that's been in place since the October lows. And I know we talked about how small caps do tend to outperform in January, but I'm curious whether the Russell hitting some of these levels changes your thinking on small caps, given that your 40 list came out before we saw this trend line?
The technicals we stay away from as fundamental long-term investors. Listen, there's value in doing that, but to us, you can end up outsmarting yourselves. And whether you get something at 5% below or 5% above, if you think something is worth double where it is now, it doesn't really matter.
I'm falling victim to the technicals notes that I read every morning, is what you're telling me.
Those notes you might want to avoid.
Okay.
All right, there we have it. All right, Jonathan Boyer, always great to have you. Thanks so much again. Top picks here, IAC and MSG, at least among the top 40 picks that you're seeing for this year. Jonathan, thank you.
Thank you.
We'll keep right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned.
We're here in Las Vegas, Nevada, outside of the Sphere. It's the massive music and entertainment venue that opened a few months ago. But the real reason we're in Sin City is for CES 2024. It's one of the largest tech shows on Earth, and we're going to be bringing you all of the news, innovations, and ideas out of...
Hey, Howie, hold on. We're not in Vegas, man. We're still in New York. And that's not the Sphere. It's a cube.
I'm going to miss my flight. Oh, taxi! Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas.
Earnings season is set to kick off next week, but what should investors expect from regional banks? Bank of New York Mellon, PNC, and Citizens Financial are among the first regional banks to report that we will get our results from over the coming weeks. While our next guest saying that a Fed pivot should benefit the group this year. Let's talk a little bit more about how regional banks are positioned. For that, we want to bring in David Chiaverini. He's Wedbush Securities Managing Director. David, it's great to see you. So right there at the top of your note, you stated the fact that you think the Fed pivot is going to bode well here for regionals. Is it still, though, too early to say that regional banks are out of the woods just yet?
Yeah, good question. So I don't think banks are out of the woods. Now, the rally is warranted, but I think upside is going to be limited because I'm not expecting the Fed to be cutting as soon as what the market is predicting. And I think these, higher rates that we're living with are still going to slow the economy, and the lagged impact of all the rate increases that we've seen over the past year have yet to manifest in the economy. So I am expecting slowing economic growth. This could impact credit quality for the banks and slow loan growth, which has been under pressure. So no, I don't think that they're out of the woods just yet.
And what about that higher for longer impact can we expect to come up most in the regional bank earnings? Is it that loan piece that you mentioned, or is it more of the deposits that we've always been talking about with regionals?
Yeah, it's a combination of both, as well as with credit quality. So deposit costs are likely to continue to increase, but at a much slower pace. In fact, I expect deposit costs to plateau within the next quarter or two, and net interest margins should trough, and net interest income should trough within the next couple quarters. So lower interest rates are helping on that side. Lower interest rates will also help on the credit quality front. But to your question about, higher for longer, that's the big risk, is when these borrowers, particularly on the commercial real estate side, look to refinance their loans, albeit at a incrementally lower rate than what was occurring, say, a month ago or 2 months ago, it's still a lot higher than when these loans were originally, put on the books. And that's where we could see some stress with some borrowers, and credit costs could end up moving higher from here and offsetting some of the impact of a rebound in net interest income in the back half of 2024.
So, David, given the fact that there's still a lot of uncertainty ahead, there are still some risks out there. It sounds like investors, if they are looking at this space, still need to be a bit defensive. Who, in your view, is best positioned then at this point?
Yeah, I would say banks that have strong capital ratios. That way they'll be in position to, put some capital to work if we do happen to get a soft landing, as well as defensive from the standpoint of if credit quality does weaken, those banks with higher, stronger capital levels will be able to withstand the blows a bit better. We also think that those banks with loan portfolios that tend to perform better in downturns should also be considered. So banks like, we like First Horizon here, we like First Citizens, East West Bank Corp, Fifth Third, Western Alliance, M&T Bank. These banks we think are better positioned for this type of backdrop.
I can't help but notice some negative tones there. Can you talk me through how your thinking on those names correlates to your macro position that we might be heading towards a recession?
Yeah, so the main common theme across these banks is that they tend to have higher capital ratios and loan loss provision levels are in pretty good shape. So I do expect them to withstand a bumpy credit environment. One of the companies that I think does have a little bit more risk in their loan portfolio, New York Community Bank, they're focused on, they're one of the leaders for multifamily lending in New York, particularly the rent-regulated multifamily lending sector. And I think that's an area that could come under stress. So New York Community is one that we are cautious on here.
David, one of the trending tickers on our site over the last couple of days has been SoFi. KBW was out with a bearish call on the stock, saying that they think shares have risen a bit too far, too fast. I know you have a seller underperform rating on the stock. What do you see as a downside risk there for SoFi?
Yeah, so the main issue, at least in our mind with SoFi, is that they've grown very quickly over the past couple years. They did have a lot of capital coming out of their SPAC transaction. They acquired a bank, grew their loan portfolio very fast, but now they're bumping up against their balance sheet capacity since they put all that capital to work. So we're expecting net interest income growth to slow materially looking out to next year. And then with our base case scenario of expecting at least a mild recession in 2024, their credit costs for these consumer unsecured loans are likely to increase. So we think there's a kind of dual headwind with SoFi in that they've reached their balance sheet capacity, and then credit costs could be on the rise looking out to 2024.
And earnings season sort of officially kicks off with JP Morgan on the 12th. I know we've been focusing on some of the smaller names, but to what extent is JPM the big bear in the room that everyone else is kind of small potatoes in comparison to here?
Yeah, they definitely set the tone with earnings season, being one of the early reporters. And like you said, they're the elephant in the room. So everybody will be focused, at least for my coverage being more commercial bank oriented. I'll be curious to hear what they have to say about commercial loan growth, credit quality. Those are the big issues. And then, net interest margins for them, while their deposit costs are definitely on the more favorable side of things with a lower deposit cost than regional banks. Nonetheless, they do set the tone more in terms of, loan growth, credit quality, and deposit flows.
All right, David, really appreciate your insights there. Thank you so much. That was David Chiaverini, Wedbush Securities Managing Director, giving us some insights heading into those bank earnings here. We're going to have all of your markets action ahead, so stay tuned with us. You're watching Yahoo Finance.
Wall Street, straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
Jefferies is out with a note today on their top ideas in the consumer sector for 2024. The firm saying that investors should look towards secular growth with attractive valuation, something we're not seeing a ton of these days, Shauna. But what I'm really interested in is that it seems like a lot of their picks center around this idea of the consumer starting to buckle just a touch under the pressures of inflation. They do mention the senior loan officer survey that I really want to point out because they talk about some of the credit tightening that we're seeing and how that could start to be the thing that buckles the consumer. Having said that, they do say that discretionary spending is actually higher than it was pre-pandemic, but that some of the market risks could start to pull that down.
Yeah, certainly. We have seen the consumer be extremely resilient up until this point. But what I thought was interesting was very similar to along the lines of what you were saying, just the fact that the consumer health maybe be a bit stretched at this point, given the fact that we do have this resumption in student loan payments. The labor market, yes, it remains resilient, but it is starting to cool a bit. You're also seeing that reflected in wage growth, which is starting to slow just a bit. And taking a look at a chart that I believe we have on credit card delinquencies, we have seen that tick up a bit along with auto delinquency rates as well, trending above those pre-pandemic levels. So that's a bit of a worrisome sign here for consumers. In terms of Jefferies' top pick, what sticks out to me is regardless of the fact that consumers are weakening, consumers continue to spend on one category. At least that remains to be the case throughout the pandemic, and that's makeup. Take a look at Ulta. It has been an outperformer. Jefferies naming it a top pick. They've got a buy rating on the stock, $550 price target. And here's why. They're making the case that Ulta is diversified across product categories and price points, and they continue to view the company as well positioned in an environment where consumers maybe are thinking twice about what they are buying on and trading down a bit. So the fact that Ulta offers products across a variety of price points really puts them, at least in Jefferies' view, well positioned, even if we do have a downturn here in the consumer.
Yeah, it's interesting because that kind of dovetails with some of their reasoning behind Walmart, which they also have a buy on, one of their top stock picks, saying that early investments in tech and e-commerce and a continued price investment have positioned it for future gains. They do note what we were saying earlier, Shauna, that they tend toward a lower consumer, but that's not necessarily a bad thing for Walmart, right? I always think about how Walmart is the biggest grocer in the U.S., so when the consumer is starting to buckle a bit, they may continue to spend at a place like Walmart as they're getting their groceries. They also note that interest from $100,000 household income customers is starting to go up as well, again indicating some of that trade down for Walmart and a mix in products as well, which is what you were mentioning as a boon for Ulta. It seems like that's also that increase in private label sales from a variety of companies is something that is getting them a little bit more attention from Jefferies as well, Shauna.
Yeah, certainly. We had John David Rainey, the CFO of Walmart, on the show following their earnings report last quarter, and he was saying just that yes, there is a bit of strain on the consumer right now. We are seeing consumers trade down, but Walmart is in a position to benefit. Not only are the consumers that have been shopping with them for years still going into their stores, but they're also starting to see those with household incomes above the $100,000 mark or right around the $100,000 mark starting to make more frequent trips to stores like Walmart. All right, we got to leave it there right now, but keep it right here on Yahoo Finance. We got much more of your market action ahead, about 30 minutes into the trading day. We'll be right back. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Madison Mills. About 30 minutes into the trading day, let's take a look at how things are shaping up. A bit of, I guess, reason to be optimistic here at the start of the trading day. You have the Dow and the S&P now trading above the flat line, positive this morning as investors digest the stronger than expected jobs data from ADP. Now, the tech-heavy Nasdaq, though, is still in the red. The move lower coming after Apple got another analyst downgrade.
And taking a look at individual names here, Eli Lilly trending on the Yahoo Finance platform today. The company warning against the use of its popular weight loss drugs Mounjaro and Zepbound for cosmetic purposes. They say they're meant for the treatment of serious diseases and not for cosmetic ones. The company also launching a new website to allow customers to get a weight loss drug prescription through a telehealth provider.
Also trending on Yahoo Finance today is Mobileye, the stock taking a massive hit after warning that it expects a 50% drop in revenue in the first quarter of the year. The self-driving vehicle company blaming this downbeat forecast on excess inventory of its IQ computer chips that are being held by some of its customers. You're looking at a drop of just about 25%.
And Home Depot moving higher after getting an upgrade from Barclays to overweight from equal weight, boosting their price target as well to $372. The analyst Seth Sigman saying he likes the exposure to housing as home prices may potentially be strengthened by reversing interest rates to come.
Ford sales in the U.S. rising over 7%, almost 2 million vehicles in 2023. The automaker also seeing EV sales climb 18% last year. Yahoo Finance's Pras Subramanian joining us now with more on those numbers. Hey, Pras.
Hey, Sean. Yeah, big year for Ford following strong reports from rivals like GM and Toyota yesterday. Noting sales up 7.1%, he said, in 2023. That's nearly 2 million vehicles. It's best year since 2020. Ford seeing big gains in its Bronco Sport SUV, Ford Edge, and Lincoln Navigator, among others. And also those EV sales up 18% in 2023 to 61,000 EVs, making it only second behind Tesla in the U.S. Ford, again, noting the F-150 Lightning and the Mustang Mach-E with sales gains there. The Lightning is interesting because of the fact that we've seen issues with high price, some recalls there for that vehicle. So it is interesting to see that actually overall for the year it did quite well. Now Q4, turning back to more recent data here, up only marginally compared to last year. This is probably due to the effect of the UAW labor strike there, affecting production in the beginning of the year. And then when you restart those factories, it takes a few weeks to get up to speed. So that's probably why you're seeing a little bit of lightness there for Q4. But CEO Jim Farley is optimistic about 2024, talking about how the company is spring-loaded for a big year with new models and things like that. So overall, a good year for Ford with earnings coming up for Q4 in early February.
All right, Pras, thank you so much for being on the EV beat for us this week and always, I guess. Really appreciate your insights there. We're going to get over to earnings news this morning's. Walgreens reiterating its full-year adjusted earnings guidance of $3.20 to $3.50 per share in its first quarter results this morning, pointing to a confidence in its sales growth while grappling with weakening demand. Joining us now to talk about the company's results, we've got Brian Tanquila, Jefferies Healthcare Services Equity Research. And Brian, Yahoo Finance spoke to Walgreens CEO about his outlook for 2024. We want to take a quick listen to that.
I think the primary headwind, as you can imagine, is the retail environment. And do we see a consumer, our consumer in particular, become a little bit more relaxed about purchasing the kind of items that we sell? We're sort of in line with what we expected. So, but still down. And so that's going to continue to be a drag on us.
All right, continuing to be a drag, and that's certainly what we're seeing in the market action this morning. Walgreens down 11% after those earnings came out. Brian, what do you think the street is most mad about here?
Hey, Madison, thanks for having me today. I think the biggest issue here is a dividend cut. They cut the dividend by 48%. Now, while some investors had been expecting that over the last 6 months, it still obviously is not good news when a company cuts your dividend. So that's number one. And I think the second thing is just what Tim mentioned in that clip that you played, right, where we are facing a weakening consumer environment, and that's translating to obviously headwinds for them. And at the same time, they also called out continuing gross margin pressure from payers cutting reimbursement for drugs that are dispensed at their retail pharmacy. So put all these together, and you have sort of a stock that had run up since Tim joined the company or his announcement as CEO. And so I think that the stock is just correcting to reflect all these news items right now.
So, Brian, given the fact that we do have this dividend cut, removing maybe a bit of an overhang here from the stock, then is this going to expand some of the strategic options that we could see from Walgreens then going forward, given the fact that they do need to make, at least it sounds like, some adjustments here to their business?
Yeah, Sean, that's a really good point. So if you think about some of these moves, right, I mean, their cash flows have been under pressure, partly because of these investments they've been making in expanding into healthcare, right? Village MD, their Walgreens Health initiative, has been a drag on the cash flow side of things. And so I think that going forward, they are remaining committed to this investment in Village and into the healthcare push. But I think on the call, what was interesting to me is Tim saying, look, we're not going to throw much more capital into this, right? We're going to continue to fund Village and some of these initiatives, but we're not looking to do more acquisitions in the healthcare space. So I think that's an interesting point. So I think capital allocation is under review today. Obviously, he's been in the seat for just a few weeks. And so I think that, while they remain committed to a healthcare push, I think that they're being more disciplined and prudent when it comes to capital allocation.
Well, I'm curious, too, then, when it comes to capital allocation, how you think this brand new CEO is thinking about what's going on with Boots. And do you think that this is going to be the year that Walgreens can get rid of Boots? It feels like they've been trying to do that for quite some time now.
Yeah, what's interesting is the international business, so obviously Boots being the big part of that, has done really well. It's one of the bright spots in the company. And one of the things that Walgreens did recently is to basically offload their pension liability in the UK. So I think that's a good first step to shoring up Boots and prepping it for a sale. So I wouldn't be surprised, to your point, if sometime this year or early in 2025, we see a Boots sale announcement, especially given how good that asset has been performing.
Brian, one of the headwinds that has been facing Walgreens, many of its rivals, has been the labor shortage or lack of available pharmacists, their ability to find the pharmacists that they need. Any idea just in terms of how big of a challenge you see that being here in 2024 and beyond?
Yeah, so I think, I think broadly speaking, the labor market is starting to flatten out, right? To ease, the pressures are easing a little bit. Now, not to say that it's not tough, right? I mean, I think that there are initiatives from companies such as Walgreens or even CVS to partner with pharmacy schools and things like that. And then automation and trying to ease the burden of the job from the pharmacist by introducing AI, by introducing more automation. So I think that these companies, especially the well-funded ones such as Walgreens and CVS, are putting in the right efforts to maximize the efficiency and the capacity of the pharmacists that they have. But certainly recruiting is an issue. But the other thing I think worth highlighting, Shauna, is that they're actually reducing their store count, right? So as we think about the number of pharmacists that they have, as you take out 200 stores this year, that obviously helps address some of those issues that they're facing with labor.
Well, when you talk about store closures, shrink comes to mind for me. And I know that Walgreens has had a lot of diverse commentary about shrink with their former CFO talking about it, saying maybe we cried too much over shoplifting. I'm curious whether you think that in-store theft is part of that calculation, or is it a little bit more pointed to the healthcare concerns that you mentioned?
No, it actually is. That's a good point, in the sense that they called it out, that one of the challenges that they face on the margin side for the retail side of the business is actually caused by shrink increasing further. And I can't tell if that's seasonal, right? I mean, obviously in the holiday season, there are more holiday products, more seasonal products in the store. So that's obviously a concern. I think that, it's a new baseline as we think about shrink that we're operating on going forward. And, it's an industry-wide issue that we're seeing across the retail space, especially in pharmacy. So I think we've reset up in terms of what those shrink levels are, and hopefully it doesn't worsen from this point.
Brian Tanquillo, always great to get your insight here. Walgreens shares trading lower on the heels of these results. Brian, thanks so much for joining us today.
Thank you.
Keep right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's the Morning Brief.
It's the Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
Bitcoin pushing higher this morning as investors continue to wait for the Securities and Exchange Commission's January 10th deadline on updates over decision for the U.S. spot Bitcoin ETF. Let's get deeper into the cryptocurrency moves with Yahoo Finance's Jared Blickery. Jared, what are we seeing on our screen here? I thought we were in the red for Bitcoin.
You know, you blink and the direction has changed. So let's take a look. You can see over the last 24 hours, Bitcoin up 3%, but it has been a rocky road this week. Here's what happened over the last 24 hours. Here is the 5 days, so we're going to go back to the last day of last year. And here we see we got a nice rise here. A lot of the rise that we've seen over the last 6 months or so has been in anticipation of the spot Bitcoin ETF. We're expecting that between January 5th and the 10th, and so that is right around the corner. But then yesterday we got a report. I don't want to get too much in depth about it because it didn't even have a lot of meat on it. It just said that there was some concern that some of the issuers who were applying for a spot Bitcoin ETF had hit a roadblock with the SEC, and that was the reason. But that has been unverified. I've checked with some of our our tech reporters here and crypto reporters, they've checked with a number of issuers this week and have not heard any problems. Doesn't mean they don't exist, but at least from our end, we haven't heard of anything like that. So here's the 5-day. Lots of volatility there, but let me just back this up to a 3-year chart, and you can see we have tremendous price memory right around 45,000. We saw this little peak here right before, so this could be a stumbling block. I'd say 45 to 47,000, pretty big resistance area. But of course, this goes all the way up to what, the mid 60,000s? It's not until we punch above that we really have free sailing to those big targets ahead, which don't have any price memory. In other words, above those last record prices that we've seen. Want to also touch on Bitcoin seasonality. This is something I ran a couple days ago. This is a map for the entire year, January through February, and we can see it's very choppy. You take a look at S&P 500 seasonality for stocks, tends to go from the lower left to the upper right, but Bitcoin does not have enough bullish history yet, and we're just seeing that in January, we actually tend to come down a little bit, find our footing in February, but watch out because we're expecting that halving in April, that could be a little bit of a fake out. We don't get the big rise until later in the summer. Just historical tendencies. We'll have to see what happens this time, but lots of attention on that spot Bitcoin ETF.
Certainly has been, and lots of attention on exactly when we are potentially going to get it. Sounds like it could come very soon. Jared, thank you. Let's turn to another big story today, and that is Disney. Disney's boardroom battle. Today is the deadline for Disney shareholders to nominate directors to the board. Now, the House of Mouse is gaining the support of a significant shareholder. Activist investor Value Act Capital Management reaching an agreement with Disney earlier this week to support the company's board nominees at its upcoming shareholder meeting. Now, this comes as Disney fends off a proxy battle with Nelson Peltz. We want to bring in Doug Kreutz. He's TD Cowen Managing Director of Media and Entertainment. Doug, it's great to see you. So let's talk about the fact that Value Act is now on the side, or I should say Disney now has Value Act on board. To what extent do you think this is going to help Iger fend off some of the pressure that we're seeing from Peltz?
Well, I don't know that I think he needed a lot of help. I mean, Peltz and his group, they don't have that much of a share position. Disney's a huge company. And so, it'd be very difficult for Peltz to amass enough shares to have a chance of really winning a vote. Obviously, if he could get other people to go along with him, that would help. Disney getting Value Act to support their view, the optics of it certainly are good for Disney. It says, hey, here's another major investor with interest in these sorts of things that believes that, our view is the correct one to help dissuade maybe anybody else from saying, hey, maybe Peltz is right. At the end of the day, I don't think it would have mattered that much if they had gotten Value Act or not. I think Peltz winning a proxy fight was a very long shot to begin with, and it's an even longer shot now.
Well, then what can be done to appease not only Peltz, but also activist investors in general here?
Well, I don't know that you need to appease Peltz. I mean, he's free to go buy shares and say what he wants, but he doesn't have any more power or rights than that. He can make a lot of noise in the press. It's a distraction for Disney. It's not something they necessarily want. But, the sort of just say no defense can be a pretty effective one if you're willing to, sort of turn your ears off and not worry about what people are saying. And I think, Disney would like this to go away, right? They've got real issues with their business that they need to deal with and not be distracted. The fact that some of the people involved in this are former Disney people makes it even a little sort of stickier from a PR standpoint. But again, at the end of the day, I just don't think Peltz has the juice here to force Disney to do anything.
So do you think it's just been a total distraction then, it sounds like, here for Disney? But what about for shareholders? Has this hurt shareholders then at least over the last couple of months?
It really hasn't helped shareholders. I don't know if it's hurt shareholders. Again, I think Bob Iger's a pretty focused person. To the extent this is a distraction, he's probably not going to let it be that much of a distraction. They're focused on doing what they can do to, turn the business around, which really involves figuring out what they're going to do with their linear networks and also fixing their content production pipeline, which has underperformed the last couple of years relative to where it had been historically. I think neither of those things are issues that have easy solutions, solutions that I think pellets can really help with. To a large extent, these are industry-wide issues. It's not just Disney that's dealing with this. It's Warner, it's Paramount, it's Comcast. They're all sort of in the same boat. The economics of linear are breaking, and the economics of streaming are still not there. I tend to think the answer is to reconstitute the bundle. That the linear bundle is obviously dying, but if you can reconstitute a streaming bundle with everybody's content, I think that's something that consumers would embrace, because it would sort of relieve them of the problem of, which streaming services do I buy to get the content I want at a time when the prices of all these services are going up. Advertising is increasingly being pushed as a part of streaming. Right. I think getting back to an all-in bundle would be something that would be very good for both these companies and for consumers. And again, that's something that I think all the CEOs of all these companies, including Iger, have some recognition of, and I don't think they need an outsider to come in and tell them that.
Right. How likely is that then, Doug?
I don't know. These are all people who, pursued a strategy for the last 5 years aggressively that I think hasn't worked. It can be difficult to admit publicly that it hasn't worked and change direction so completely. I don't know that I think it's going to happen this year. I think numbers across the industry will get better to a certain extent this year because of the price raises and because the spending on streaming content has slowed down. I just don't know if they're going to get better enough to get shareholders to want to embrace these stocks again.
All right, Doug, that's really interesting insight. Really appreciate you joining us on that. Our thanks to Doug Kreutz, TD Cowen Managing Director of Media and Entertainment, for talking all things Disney here. We're going to have more action on the market side of things ahead, but stay tuned with us for more. You're watching Yahoo Finance.
If you can talk about one big theme for 2023, it has to be AI.
The AI hype cycle has swept the nation this year.
AI is still drawing a lot of attention.
The AI boom.
AI boom. Increasingly powerful AI models.
AI. Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas. We'll bring you the latest news, innovations, and big ideas in artificial intelligence.
Well, the possibility of future rate cuts fueling optimism in the merger and acquisition space after a slow 2023, to put it lightly. But is it all good news? Our next guest isn't so certain that rate cuts are a good thing for deal making. We're going to turn to Mark Cooper, Solomon's CEO, to tell us more. Mark, thank you for joining us. I had the pleasure of getting a little preview conversation with you a few weeks ago, and I remember you saying you just want to keep things nice. You want rates to stay where they are so that we don't have any muck in the deal making space. Is that still your base case?
That's my wish case. My wish case is that it's always just nice, that it doesn't fluctuate between 0% interest rates and then driving up to higher numbers to fix what ails us. So, but my judgment tells me, and by the way, hi Maddie, my judgment tells me that this year you'll see some stability in interest rates. And I don't, people are calling for rate cuts. Maybe they come. I'm not, as I think I mentioned to you last, I'm not expecting any nor betting on any. But I think this is a rate environment that we can transact in. I think a lot of what happened last year, among other things, was simply uncertainty. Where was it going to end? Or when was it going to end? What was the top end of the rates? Now that you have confidence that we're not going any higher, people can price risk.
So Mark, then what do you think activity is going to look like this year? If you do get your wish list or your wish case, I guess is a better way to say it, at this point, what do you think activity is going to look like between now and the end of the year?
Better.
Not great.
So the last year was a tough year. And it was a tough year by historic standards. Now we had some mega transactions that maybe skewed the dollar volume of M&A, which I think was only down 7.5% in the U.S. But when you look at deal count, it's down, almost 20%. If you look at middle market PE, is almost down 40% in deal count. So those are some pretty significant numbers. In particular, the PE community has been on the sideline for quite some time. So I think when you look at the combination of rate stabilizing, so people could price risk with some certainty, with the idea that the PE has some pent up demand, both to make acquisitions and to return capital to their investors, and that requires transactions. And then the last piece, which is interesting, is what drives corporate mergers. And you have a few things going on with a slowing economy or a more stable, low growth economy. M&A becomes an important way of creating growth. I think you'll see more corporate transactions. The second piece, which is cash balances. Cash balances are up, I think it was like 40+% of the S&P 500 over the past number of years. So there's some, big dollars sitting on the sideline. You couple that with a more agreeable financing market, and you've got some positive ingredients that should drive M&A.
So what about how long this process is taking, Mark? I'm a little bit tired of having to talk about the same M&A deals week after week. I'm sure it gets more tiring for you than it does for me. What's taking so long?
Maddie, I wish I knew. But the answer is I'm going to give you more names, because there are going to be more names. And I think what's simply taking so long is, I wouldn't tell you it was a risk-off market in M&A, particularly in the corporate side. It was more of a risk conservative market, I would say, for the private equity side. And I think that's going to turn. And we're seeing it. We're seeing it in backlog of transactions that we have in-house, which is the best backlog we've had in years. We're seeing it in pitch count. So how many PE sponsors or how many companies are looking for bankers to help them transact M&A. So it's really active. Now, I think there'll probably be some transactions in the first quarter. Those would be carryovers from last year, but I think you'll see a bigger pickup as the year goes on.
So, Mark, if we are in a baseball game here with M&A deals ticking up, what inning would you say that we're in the race to kind of speed things up here?
That's a good point. I'm not a huge baseball fan, but
You think I'm a baseball fan? It's just for the point of the question, Mark.
Let's go for football. I would say we're on the 50-yard line, going the 50-yard line. How's that?
There you go.
And it's better than being on the 20 going the long way, right? So, and I think last year we were on the 20 going the long way. I certainly think we're on the 50-yard line, and I am pretty darn confident that 2024 will be a robust year. It almost has to be. And there's a lot of pent-up demand. Now, we could talk about longer-term trends, which might be different. But I think in the short term, there's just a lot of reasons why things have to get done this year.
Mark Cooper, it's great to get your insight here. Look forward to having you back and talking about some of those longer-term trends. CEO of Salomon. Thanks so much, Mark. Well, former President Donald Trump is asking the Supreme Court to keep him on the ballot in Colorado. Now, this comes after the state's highest court ruled that he was ineligible to run for president based on the insurrectionist clause. So what happens now? Rick Newman, Yahoo Finance reporter, here to tell us a lot more. And Rick, what does happen? What do you think the reception is going to be like from the Supreme Court?
Well, the Supreme Court has not yet said, yes, we're going to take this case, and also the other one in Maine, it's probably working its way up to the Supreme Court. But it seems likely that it will, because it would just be confusing and chaotic if the Supreme Court didn't issue some kind of ruling here. Once the Supreme Court says it will take the case, I think we can expect them to act quickly. But what they're going to say, nobody knows. I mean, I've seen solid legal analysis on each side of this, saying Trump did engage in insurrection, and therefore Colorado is a solid case. Or it would be crazy for the Supreme Court to do this. They need to let the voters decide. I mean, it could go both ways. I mean, interesting, if you get into the 14th Amendment, and INAL, I'm not a lawyer, but the 14th Amendment, that's the issue here, says that a candidate only needs to engage, that word engage, in insurrection. It doesn't say that the candidate needs to be convicted of insurrection. So if you just read that in plain English, it sort of sounds like it leaves it up to the individual jurisdiction. And states do have the power to set their own elections the way they choose. I mean, state constitutions are all different about how elections are held in various states. So at a certain level, states do get to decide. So, I mean, it's really interesting. And then if the Supreme Court says, no, this is invalid, then it seems like we just go ahead with the election normally. But the can of worms is if the Supreme Court somehow says, yes, states can make this determination. So then what happens? What other states might say, oh, there's an opening, so now we want to see if we can keep Trump off the ballot. It may not matter that much for the primaries because Trump is such a shoo-in. Yeah. But what about the general election? I mean, what if one or two swing states somehow keep Trump off the general election ballot? I mean, that could be decisive. So this is a huge issue.
Well, and then it makes me wonder what happens with the results of those primaries, right? We've got New Hampshire coming up. What happens to that if then SCOTUS upholds this and then we see a state where they already had a primary changed their decision here? Then what do they redo the election?
Nobody knows.
What do they do?
Nobody knows. So, and the other fun fact is that the ballots are being printed now. I mean, we're practically in primary season. So at one level, you think the Supreme Court almost needs to take this case and decide it by like next week. Right. But that would be unusually fast for the Supreme Court. I don't think we know. I mean, Trump is so far ahead in the primaries that, let's say it just was Colorado and Maine and it was just the primary elections. Trump would win anyway. Right. He would be the Republican nominee anyway. But if it goes further than that, then I think, it could be all bets are off. And by the way, people say, why are these other candidates, Nikki Haley, Ron DeSantis, why are they even running given that Trump has such a huge lead? This is one reason why they're running. I mean, candidates always want to run because they get famous on other people's money. That's, donors fund you and suddenly you're a name brand and you can make money as a commentator or whatever, selling deodorant. If Trump goes down in flames, I mean, that is why Nikki Haley and Ron DeSantis are there, because there are more wild cards in this election than in any other election in memory.
A lot of questions about how everything is going to go here over the next 11 months or so. Rick, thanks so much.
Bye, guys.
All right, keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief. Your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
We're watching shares of fast food giants Yum Brands and Papa John's after Stifel hit both stocks with downgrades. Yahoo Finance's Brooke DePalma has the details for us. Hey, Brooke.
Good morning. That's right. Stifel analyst Chris O'Call saying in a note that he's downgrading shares of Yum to hold from buy. Now, he cited that Yum would benefit from franchisees raising menu prices to combat inflation. But Yum Brands is still lagging behind competitors McDonald's and Chipotle, which both had stellar quarters in their last quarterly results, beating expectations on the street. Now, he expects fewer catalysts for shares of Yum Brands in 2024. He noted three top concerns. He expects U.S. comp sales to likely moderate with less pricing. He also noted international markets are expected to remain soft, and he noted another year of above average unit growth. Now, the street is expecting unit growth of 5.7% this year.
And that's compared to 5.9% in 2023. And he noted that without accelerating comp sales performance, they just don't see much upside to the street's earnings per share estimates come next quarter. Now, in addition to that, another stock that he also downgraded with shares of Papa John's to sell from hold. He said that it's looking a bit, well, overbaked. I like that analysis. Three concerns that he had there was he expects net unit growth to fall short of street expectations for 2024, citing less development in the UK and development in China that could moderate as well. Another concern is domestic comp sales growth falls short of expectations. And his top concern here is the turnaround of the UK market. He said that could take several quarters to gain traction. But Sean and Maddie, last time I spoke with Rob Lynch, that's the CEO of Papa John's, he did note that the UK is more of a long-term strategy for them.
Brooke, there are some reasons here, at least in the terms of through Stifel's eyes, that we should be a little bit concerned about some of these fast food players. He was, though, a fan of a couple of names. Who does he think is best positioned then?
Yeah, some newcomers to the market. Cava is one of them, in addition to Wingstop and Domino's Pizza, of course, a longtime play there. He noted that he sees attractive unit economics there. So, for example, Cava continues to see improved average unit volume. Last quarter, they saw 2.6 million for their average unit volume. And two others that he liked here was Darden Restaurants and Brinker International. He noted compelling risk-reward propositions with strong momentum behind their same restaurant sales. He also noted strong cash flows and balanced street optionality. So definitely some to watch there, but also some to be a bit cautious of as well.
All right, Brooke, thanks so much for breaking all of that down for us. Let's talk about a new survey that has just been released. A new survey revealing that business leaders are still split on recession forecasts for the year ahead. But as inflation continues to moderate and the Fed contemplates rate cuts, more and more leaders are paring back their odds of a recession. A new survey out from JP Chase revealing that 40% of mid-sized business leaders anticipate that a recession or believe that we are already in one. That's down from 65% a year ago. Joining us now is Ginger Chambliss, head of research for commercial banking at JP Chase. Ginger, it's great to have you here. So talk to us just about what you're hearing from business leaders right now. It still sounds like they're a bit cautious heading into 2024, but a bit more optimistic if we compare it to last year's levels.
Yes, and thanks so much for having me on. So we take this survey once or twice a year to take a gauge of how business leaders are feeling in terms of their business prospects and outlook for the economy. And there were a few notable changes in this year's survey relative to the one that we took a year ago. In terms of the changes, first and foremost, there was less pessimism in terms of their national outlook on the economy than this time last year. And as you noted in the intro, along this same vein, we see fewer business leaders that are anticipating recession in 2024. When we were heading into 2023, there was a majority of small and mid-sized business leaders expecting recession. Now, as we look forward to 2024, that's about 40% for mid-sized business leaders and about 50% for small business leaders. Now, one area that remained the same relative to last year's survey was in terms of business challenges. The top challenges that business leaders are facing continues to be labor issues.
Right.
So that would include tight labor shortages, attracting and retaining talent, things like that. And then also inflation. So we have seen some moderation there, but it remains a top challenge for business leaders.
Well, I really want to circle back to that, Ginger, because when I hear that these businesses are still struggling with labor, I just kind of can't believe that we're still having this problem. But it does make sense given that we still see some good numbers in the jobs data that indicate that there is a mix of job openings across the country and hiring continuing. What does your data tell you about what types of businesses are still struggling to find employees and to retain talent?
Sure. So our business leader survey really is across all industries and, like I said, small and mid-sized businesses. And what came out of the survey is that there is 86% of mid-sized business leaders expect to maintain or add headcount in 2024. So that's still a pretty high number, and I think speaks to the idea that businesses are still looking to add workers, even in this environment where they're still somewhat tempered in terms of their outlook on the economy.
Ginger, what are you hearing just about, given the fact that there are still so much uncertainty out there, there's a lot of hesitation from these business leaders, just their ability right now to raise capital? Obviously, it was extremely tough looking back to the numbers that we saw in 2023. Has that at all, the outlook improved here for 2024?
Yeah, so a couple of thoughts on that. I'd say broadly speaking, for the small and mid-sized business leaders, what we're hearing from them is a little bit less in terms of anticipating significant credit needs in 2024. Their CapEx plans are a little bit more tempered. This all makes sense in the context of elevated economic uncertainty and pretty balanced views on the economy and business environment heading into the year. In terms of innovation economy, so that's another segment of the business leaders that we took a survey on. And that area of business has seen very significant challenges in terms of capital raising over the last year. And as we look forward to 2024, there may be about half of those business leaders that expect to look to raise capital over the coming year. And so it's a bit more tempered given the environment.
And Ginger, going off that, we have certainly started to see the numbers come out that we are beginning to see a rise in bankruptcies, expectation that maybe that could continue here to 2024. Did you get a sense just about how confident some of these business leaders are in their company's ability here to survive over the next 12, 18, 24 months?
Yeah, sure. So again, in terms of the small and mid-sized business leaders, those leaders continue to be confident in their prospects over the coming year. We continue to see a majority that expect revenue growth and a majority that expect profit growth over the coming year. In innovation economy, those business leaders are even more optimistic. They tend to be opportunistic and optimistic cohort of the economy, given their entrepreneurial spirit. They remain even more bullish in terms of their prospects over the coming year. Now, there are certainly some areas of caution with regards to how this looks in a longer term context, but the numbers still say that they're optimistic in terms of their ability to generate revenue growth.
All right, Ginger, thank you so much for joining us. That was Ginger Chambliss. She's with JPMorgan Chase as the commercial banking head of research. Ginger, really appreciate it. We're going to have all of your markets action right here ahead, so stay tuned. You're watching Yahoo Finance.
If you can talk about one big theme for 2023, it has to be AI.
The AI hype cycle has swept the nation this year.
AI is still drawing a lot of attention.
The AI boom.
AI boom.
Increasingly powerful AI models.
AI.
Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas. We'll bring you the latest news, innovations, and big ideas in artificial intelligence.
Well, TikTok appearing to have its sights set on competing with Amazon in the new year. The company wants to invest $17.5 billion in growing out its U.S. e-commerce business in 2024 through its TikTok shop. Now, this is all according to recent reports here, Maddie, from Bloomberg. We have been talking about the fact now for quite some time, for the last several months, that TikTok has set its sights here on the U.S. That $17.5 billion number, the valuation there, the amount that they could pour into this, is the new part of this report. The question is, though, how successful it's going to be, and also what it means not only for Amazon, but for a name like Shein as well, in terms of more competition within the space.
Absolutely, and we know from this report as well that sales in Southeast Asia were the majority of those sales from TikTok Shop. So right where you're seeing a lot of sales from Shein and Temu as well, definitely a potential to take up some market share there. Having said that, TikTok did say in a statement that this $17.5 billion number was inaccurate, but Bloomberg reporting this after conversations with people off the record. Interesting to note also overnight, TikTok increasing the fees for sellers on the platform from 2% to 8%, so quadrupling the amount of money it's going to cost sellers to put things for sale on TikTok Shop. This is kind of the story that we've seen time and time again with social media giants, right? It's really easy entry. We're going to beef up your videos, get tons of views. We're going to make sure that if you're selling something, you get a lot of runway on the app. But then once we have a little bit of clarity on how many people are going to be using this, suddenly the algorithm changes or it becomes more expensive to participate, Shauna.
Yeah, we will see how successful this could potentially be here in the U.S. You don't want to bet against TikTok, given the fact that they have such a wide reach there for their users. Well, that's all for now. Let's do a quick check of the markets 90 minutes into the trading day. You're still looking at the Nasdaq. Actually, right now, well off its lows of the session, just below the flatline. The Dow and the S&P moving to the upside. You have the Dow up just about 200 points. Rochelle Akufo has you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Another hit to Apple after Piper Sandler downgraded the stock on concerns over iPhone sales. We'll break down the hit to the tech giant's market cap. And Conagra Brands is giving a cautious outlook for the year, slashing its full-year guidance as it expects consumers to buy less packaged goods. We'll discuss those results this hour. Plus, CVS is doubling down on cost savings, announcing it's cutting ties with AbbVie's Humira on April 1st. What this means for the healthcare space later on in the show. But first, let's check in on how the major indices are trading an hour and a half into the trading day. Looking at a mixed picture here, it was a jittery start after the Fed minutes threw cold water on that quick pace of interest rate cuts markets priced in. But as you can see here, now reaching for daylight, all three in the green here. The Dow currently up about 200 points, or about 0.5%. The S&P 500, they're also up about 1/3%. In terms of sector action, looking at financials leading the way, tech and energy under pressure. They were the laggards so far this morning. And the Nasdaq still relatively flat there, up just about 5 points. Let's also check in on what that did for the Treasury market as well. Looking at the shortest term 5-year, that's currently up about 1.75%. Looking at that 10-year continuing to climb, up 1.87% there though, just shy of that 4 mark. And of course the longest term 30-year yield, that's up 1.85%, sitting at 4.13. Well, Apple is taking a pounding this week. The tech giant getting a second downgrade this morning. Piper Sandler's Harsh Kumar cut his Apple rating to neutral from overweight after holding that bullish view since March of 2020. Now, he cited in a note that a weak macro environment in China will dampen demand for iPhones. Barclays was also concerned about those iPhone sales, as well as waning demand for Mac laptops and iPads. Now, this isn't a common occurrence for the tech giant. Let's put that in perspective. It really is used to getting love from the street. A favorite, of course, of legendary investor Warren Buffett, the stock has only 5 sell ratings, according to Bloomberg. Now, the stock has been falling for the last few days amid these calls, weighing on the tech-heavy Nasdaq. Here, with how much of a massive market cap the stock has lost, is our very own Jared Blickery. Strange times indeed here for Apple.
Yeah, it really is. I mean, you put the macro environment in terms of what's happened this year in the charts, kind of strange. But let's focus on Apple, down 1.38% today, and we'll get into the market cap calculations in a second here. Just want to show you, in the 3 short days of this year, Apple already down 5.6%, and the rest of the mega caps have not fared much better. I want to get to some of the analyst commentary. First, Piper Sandler today kind of doubling down on the Barclays note that we saw earlier this week. Piper is concerned about handset inventories, growth rates. Those have also peaked for unit sales. That's their belief. They're also concerned about currency headwinds. That means a stronger U.S. dollar. By the way, the U.S. dollar has been stronger this year, coming off a pretty big support level. So that headwind could not only continue, but mount. And then the interest rate environment. It's not just the idiosyncratic problems and concerns of the company. It's also the global environment. So higher interest rates are a headwind for Apple as well. And here's a brief quote from Barclays from the other day. iPhone 15 has been lackluster, and we believe iPhone 16 should be the same. So Tim Long, similar view there, although they did issue a sell equivalent rating on this stock. And when you take a look at the market cap drops this year from the Magnificent Seven, Apple by far and away leading the pack, $129 billion. That's about as of 30 minutes ago. Nvidia down almost $50 billion. And then we kind of trail off there. Microsoft 40, all the way down to Google, down only about $8 billion. Hasn't really been hit that hard this year. But I do want to take these losses in stride here and compare them to the 2023 gains, because Apple and Microsoft both saw gains in market cap of $1 trillion last year, dwarfs what's been lost so far this year. Nvidia's up there, Amazon, Google down the line, even Tesla, almost $500 million gained last year. So you put it all into context here. Tech has definitely fared poorly. This is a Nasdaq 100. I'm going to switch this over to our sector look. And there's XLK, the worst performer of the year, down almost 4%. So in as much as Apple is a bellwether for tech and tech is a bellwether for all kinds of things in the risk community, not looking good so far this year.
Indeed, and it's hard once you think of those highs that we saw after that AI boom really pushed the Mag 7. So important to have that context. We appreciate you breaking that down. Our very own Jared Blickery. Well, stocks climbing but jittery this morning after opening 2024 on a downtrend. This, of course, followed the year-end rally we saw to close out 2023. Our next guest suggests that investors should use these pullbacks as opportunities in the market. Joining me now is Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. Good to have you back on the show here. So, for investors who are, feeling a little bit jittery, not sure of where they stand at the moment, especially after the Fed threw some cold water on how long they'll be holding rates for, how are you gauging buying the dip in this environment? Where do you see the opportunities?
Yeah. Well, first, great to be with you this year, Rochelle. As you mentioned, we had a tremendous rally at the end of last year. We had a 9-week winning streak for the overall market. That's the longest winning streak since 2004. So our expectation is coming into this year is the first part of the year would be somewhat choppy, at least the first quarter would be somewhat choppy because you've had such a strong move. But I will say this, you hear the term a lot, the market's overbought. And you can say statistically it is. But we've done some work around this. And if you look at something called the Relative Strength Index, which I'm sure a lot of your viewers are familiar with, it's a momentum indicator. And it got above 80 for only the 16th time since 1980. When we look forward 12 months, that's actually a good omen. Markets have been up 13 out of 15 times with above average gains. But on the short term, you tend to give some of that back, and that's what I think we're seeing. So I would say stick with the underlying trend, which is still positive, and look to pullbacks as an opportunity to add if you're underweight equities.
Okay, so if you're thinking of now adding in, if you are pulling back from some of these mega caps, where are you looking? I know small caps also suffering a bit so far this year as well.
Yeah, so one area that I think is still relatively attractive, even today, even if we have a bit more of a consolidation, is the equal weight S&P, right? So as you know, and as most of your viewers I'm sure are familiar with, that index provides the same weighting to each stock in the S&P, so it's not so concentrated. And even with the broad rally we saw at the end of the last year, it trailed the traditional S&P by about 12 percentage points. Now, that's the most underperformance that we've seen since 1998. So the valuations are a bit cheaper there. They have a bit more financials and industrials. So I think that's a good way to hedge some of the near-term kind of softness we're seeing in technology. Though I think over the year, I think both areas will do fine. And Michelle, if you want, we can talk a little bit about small caps if you want as well.
I do want to dig into that because a lot of people are wondering how to play this market at the moment and what's the good way of really telling the small caps to hold on to, given some of the ones that have been really beaten up over the past year?
Yeah, so we are still emphasizing in our portfolios more large caps and having that equal weight hedge. I do think, small caps do, especially for longer term investors, look attractive. Even they went up 25% from the October lows. So now you're pulling back and likely you're also going to consolidate. But I will say this. The relative valuations are still at the lowest level, towards the lowest level we've seen in about 20, 25 years. The underperformance was still an extreme for the whole year as well. And they were also getting hit a lot by the Fed moving rates higher because they have a lot more floating rate debt. So as interest rates or the Fed starts to pivot, that should be a positive. So I think, again, folks that have a little bit longer time frame, that relative valuation is at an attractive point, even today as we've pulled back the last couple of days.
And Keith, you know that this isn't the time to sort of just set things on autopilot, but how do you strike that balance between sort of not jumping at every data point or, a bit of Fed speak that comes out versus having things on autopilot? How should investors look at that?
Yeah, it's a good question. So in our overall portfolios, I mean, we're not all the way to like on offense or defense. We're somewhat in the middle right now, waiting for tactical opportunities like we had in October where we kind of said, hey, this is a really good buying opportunity at the end of October because things got so oversold. So I think there's a bit of being patient. During this year, we're going to have over 40 elections globally, including in the U.S. There's still this debate about, what the market's pricing in for the Fed cuts versus what they actually do. There's still questions about inflation. So I think the way to be is try to keep an even keel with an overall portfolio asset allocation. But as you start to see some extremes with some of this headline risk that we have this year, I think we will be looking for those to either add to equities or if we have a rip at some point, taking back. So I think it's just going to be a period of time where you're going to see more tactical opportunities both on the upside and downside, and investors should be prepared to take advantage of those.
And Keith, we have to talk about the bond market as well. But as you're looking domestically and internationally as well, what is the best way to sort of manage some of the risk here as we're still seeing that choppiness?
Yeah. we're still Team USA. We've been big U.S. bulls for several years, and part of the reason why the U.S. has outperformed for so long is the earnings momentum and the quality of the earnings are much stronger in the U.S. relative to international. Now, I will say international markets are very cheap, but valuations are a condition, not a catalyst. So we would be waiting for those earning trends to turn around more strongly internationally. That typically happens when you have more of a global economic recovery. That's not our base case. So we would still be underweight international. We have been more negative with emerging markets where we've removed that from our portfolios over a year ago. And we still think there's some challenges there as well. So again, likely some opportunities later in the year. We would still stick with the U.S. And if you think the economy may surprise to the upside, I think you can get better cyclical exposure by going to small caps in an equal weight relative to some of these areas in the international markets.
And Keith, of course, as we head into the middle of this month, we'll kick off earnings season once again. What are you going to be looking for on some of those earnings calls as you're sort of trying to seek some direction as to how companies are viewing the environment right now?
Well, I will say, if you think about last year, why did the market do so well relative to expectations coming into the year is that earnings were really strong. In fact, when we look at forward earning estimates, they're at a record high. So most of last year, those earning estimates continue to move higher. So I think one of the key things you want to look at this earnings season is profit margins, right? If the economy is going to take a little bit of a step down in growth relative to last year, are companies able to maintain those profit margins? So I think that's the big story. I will say, I think it's been pretty remarkable on how corporate America has handled, this whole pandemic era. And I will say, that I suspect they will be able to, in many cases, to hold on to those profit margins also. And I think earning estimates will continue to track higher during this year, which should support the market over the duration of the year.
Indeed. I mean, we're bracing for that recession that didn't hit, so everyone's sort of hedging their bets at the moment. But yes, as we saw from last earnings season, things seem to be relatively flush at the moment. I appreciate you joining me this morning, Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist. Thank you so much.
Thank you.
All right, watching shares of Peloton surging this morning on news that it struck a new partnership with TikTok to create a fitness hub on the social media platform. Now, TikTok users will be able to see custom social content from Peloton featuring their official instructors, as well as celebrity collaborations through the hashtag TikTokFitness. Now, this will be the first time that the workout equipment company will produce content for a program outside of its own network. Once a pandemic darling, of course, Peloton has struggled to hold on over the last few years. Now it looks to attract a wider array of customers and boost subscribers amid falling sales. The stock lost over 20% in 2023, even amid the tech rally. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. Shares of Conagra trending on Yahoo Finance this morning after the company posted mixed results in its fiscal second quarter earnings results, but cut its fiscal 2024 guidance based on slower than expected volume recovery. Let's bring in Yahoo Finance's Brooke DePalma to give us those details. Hey, Brooke.
Good morning, Rochelle. Conagra brand certainly under pressure this morning after the company updated its fiscal 2024 guidance as it continues to expect slower pace of recovery. It also said that it wanted to directly reflect the results that it's seen so far. The company now expects adjusted earnings per share to be in the range of $2.60 to $2.65. That's compared to a prior projection of $2.70 to $2.75. Now, it does also expect organic net sales to decrease this year in the range of 1 to 2% compared to its earlier forecast to grow about 1%. Now, this did get lots of buzz on the earnings call, many investors asking many questions. And on the call, CEO Sean Connolly, he did provide some color to investors. Take a listen.
The macro environment that we talked about in Q1, I mentioned again today, it persisted into Q2. So we've just seen fewer purchases in our first half than we would have assumed at the beginning of the year. So that's part of the call down the top line. The second part of it is I don't want to sign us up at this point for any kind of heroic volume recovery in the back half of the year because, I think the mood of our investors is let's be prudent, let's be up the middle of the fairway, let's put some targets out there that are not making any grand assumptions that we can meet or beat.
Now, as this continues, as they're taking this all into consideration, the company is announcing new advertising investments focused on their biggest brands, which many of them household names. So think Bird's Eye Healthy Choice, as well as Slim Jim. The company also focused on innovation. Sean Connolly saying on the call that fiscal 2024 is one of the biggest innovation slates yet. They're pointing to that canned Wendy's chili that came out in April, certainly hoping that brings consumers in to try and seek new options since they're pulling back on those no names.
It's true, really trying to get a gauge on the consumer. And of course, Brooke, as consumer behavior shifts, they seem to continue. It is directly impacting volumes and price mix. What did the company say about that?
Yeah, well, we do continue to see negative volume. This past quarter, volume decreased by 2.9%, largely led by grocery as well as their fridge and frozen food business. Now, this does come as consumers continue to shift what they're buying. They're looking to do more scratch cooking. So that ultimately means buying, say, beef and rice and making more of a larger meal. And they're pulling back on those single serve. We did see that somewhat improve in the frozen food aisle this past quarter from Conagra brands, but they do have lots of investments moving into the second half of the year. They did note that as that experiential consumer shifted to more experience options, they're pulling back on perhaps spending more on these key items and going to more private label options in the food aisle. And so certainly lots of momentum moving into 2024, but lots of recovery ahead that needs to be done.
Well, that's interesting. I know we've talked about sort of the snack environment, so interesting to see some of the nuance showing up here as well. Yeah. I appreciate you breaking that down. Our very own Brooke DePalma. Well, construction spending was on steady ground in 2023. The Commerce Department reporting a 0.4% rise in construction spending for November, following a 1.2% rise in October. Now, a lot of the resiliency is attributed to non-residential structures, according to the Census Bureau. Now, this came despite headwinds like higher interest rates, structural issues in commercial real estate, and the tightening in lending standards following regional banking failures. So what can we expect going into 2024? We have Bernard Yaros, Oxford Economics lead U.S. economist, joining us now. Thank you so much for joining me this morning. So I want to first start with what we see in terms of construction spending, something of a bellwether of how the overall economy tends to do. Break that down for us.
Right now, what we're seeing is that there's a lot of strength. It's very highly concentrated within private non-residential construction. It's not broad-based. And it's very much within manufacturing structures where we're seeing a lot of the strength. And even within manufacturing, this is not a widespread manufacturing boom. It's really just concentrated, heavily concentrated in computer, electronic, and electrical industries where you're seeing a lot of investment in structures right now. And this is really going counter to all those headwinds that you outlined at the very beginning of the segment. And this really has to do with recently passed legislation by Congress in 2022. So here we're talking about the CHIPS Act and the Inflation Reduction Act. So the CHIPS Act encourages investment in semiconductor fabrication through federal grants and tax credits. And the Inflation Reduction Act also similarly provides incentives for clean energy production and manufacturing. So what we're seeing is a lot of investments in structures in these industries that has really reflected the wave of capital investments that we've gone in semiconductor fabs and battery manufacturing. And even outside of manufacturing structures, we're starting to see a revival in power structures, especially outside of electric and outside of oil and gas. And this points to to a resurgence in wind and solar energy facilities, their construction. Also, you're seeing more transmission lines that are needed to bring renewable energy, to connect renewable energy to the existing grid. So we're also seeing some strength there. So a lot of this really, it's really been fiscal policy that has insulated some of this key area from a lot of these challenges, especially rising rates, tighter lending standards, and then just overall structural headwinds for certain areas of commercial real estate.
And Bernard, when you see this sort of growth really being reliant or because of being really propelled by fiscal policy, are there some risks that come with that? Perhaps if, we know that with these sort of buildings comes a lot of growth in GDP. Is there a danger, though, that it won't pay off?
So it's a lot of the spending. It's supporting growth in business investment and structures, which is not. It's not the end all be all for when it comes to growth. That's related to the consumer. But it's we still think that this has legs for this year. This isn't the economy hasn't been relying on this on this area for this for the resilient growth that we've gone over the past year. And I think there is. The risks are probably later down the road if we have a change in Congress and a change in the Oval Office where there could be some adjustments made to these tax credits. But for at least for this next year, I mean, there's a lot of reason to believe that this is still going to continue. These tax credits are not going anywhere. And when it comes to semiconductor, I mean, there's still that impetus among businesses to reshore the production of sensitive electronics, given the trauma we've all had with the supply chain issues during the pandemic. And then I would also say that generative AI, that's also a potential tailwind that could show up more fully this year, especially as manufacturers address the growing needs of the data center industry. So the risks are potentially for later on when you could have some changes in the political makeup. That there's a lot of question about the Inflation Reduction Act tax credits, but that's more of a question, I'd say, for the middle of the decade or later on in the decade, not so much for the outlook this year.
And as we look at potential bottlenecks when it comes to things like supply chains, we saw what happened with lumber prices, a lot of mismatched supply and demand there. But given the growth that we're expecting to see here, are there any supply chain issues that you're expecting here, especially when you think of semiconductors and sort of getting some of these products imported?
We're not. That's not our base case. But of course, there's all sorts of geopolitical risks that could create a lot of issues in the semiconductor supply chain, especially thinking about Taiwan. But for now, that's not our base case. And over the long term, I think these investments in semiconductor and fabrication here domestically should pay dividends for the nation's overall supply chain resiliency in these critical supply chains.
And of course, people are always asking about, residential prices as well. Looking at some reports we saw from Goldman, they're expecting mortgage rates to continue to tick down this year and next year. When do you think that's going to catch up in terms of supply and demand so that those who have been waiting on the sidelines are able to get into the market?
When it comes to, so also looking at this construction spending report, the residential side has been very strong, especially in the single family side, and that this comes as mortgage rates have fallen by more than 100 basis points, and this is since their peak in October, and this is unlocking some additional demand for new homes. And so we do expect that in this environment, home builders are going to be taking advantage of a frozen existing home market where homeowners are reluctant to sell. And they've been really they've been able to juice sales through mortgage rate buy downs and price cuts. And with inventory still very low in the existing home market, I mean, we continue to expect that the home builders will continue to grow their to continue building. And this is important for the economy, at least from a growth perspective, because we cannot rely on the multifamily side to support growth over this next year. It's really going to have to come down to single family. And that's just because, I mean, at least in the apartment market, we're seeing loosening conditions with rising vacancies and weaker rental growth. And you've already got a historical backlog of multifamily projects. So there's not going to really be an incentive there for multifamily builders to really take on new projects. So the strong fundamentals that we see, especially with lower mortgage rates, still demand for new homes when you can't find an existing home for sale, right? It's very tough to find a for sale existing home. That's really going to at least provide support. It has through the end of last year, and it should through the beginning of this year.
We'll certainly keep an eye on that. Appreciate you joining me this morning. Bernard Yaros, Oxford Economics lead US economist. Thank you so much. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. In a surprise twist, notable investor Cathie Wood has started buying Tesla shares after spending the majority of 2023 selling them, saying that Tesla could grab more market share as other US companies like GM and Ford step away from EV plans due to profitability concerns. Now, this comes as investors grow increasingly worried about Tesla's performance in the domestic and international markets. Rival BYD's cheaper models are overtaking Tesla's leadership position in the global market, surpassing sales for the first time, making the Chinese EV maker the global #1. Well, Tesla sold over 94 China-made EVs in December, marking a 68.7% increase year over year, according to the China Passenger Car Association. But this comes at a time when global competition in the EV space appears to be at its highest, with China's rival BYD sales surpassing Tesla deliveries for the first time ever. Let's bring in Levi Tillerman, author of The Great Race, the global quest for the car of the future. Good to see you, Levi, and Happy New Year.
Good to see you, Michelle.
So for people who aren't familiar with sort of how Tesla and BYD stack up, obviously they saw BYD overtake in terms of quarterly sales here. But as we set the stage here, who is on top in terms of market share and sales and really the strength of the companies?
Well, I think Tesla and BYD are really two of the most interesting stories in the electric vehicles market. Tesla is the original pure play in electrification. And of course, it started with Elon Musk and some other founders building this thing up from scratch on the back of California's EV subsidies. BYD is a little bit different. They started as a battery company in the mid 1990s, and then they transitioned over to electric vehicles over the course of many decades. In 2002, the founder of BYD purchased a state-owned auto manufacturing company called the Sichuan Auto Manufacturing Group. And they were producing a lot of internal combustion engine vehicles, which is standard gasoline-powered vehicles, for decades. When I published my book, The Great Race, in 2015, BYD was one of the largest sellers of non-electric vehicles. But now BYD has transitioned to exclusively selling electric vehicles. They don't sell a single car that doesn't have a plug on it. While Tesla still sells more pure electric vehicles that only have a battery, if you combine extended range electric vehicles, which combine a motor plus a battery, and of course plug in and can get electricity from the grid, plus pure electric vehicles, BYD is on top. And so fascinating companies. They'll be very interesting to watch in the years ahead.
So then what do you see as the potential biggest risks to their dominance? You mentioned some of these EV policies in California that have, really helped propel Tesla, but then you also have, when you look at regulators in China, you think of BYD. What do you see as the biggest risks to their respective dominance?
Well, I think the EV market is still fundamentally driven by policy at the end of the day. What we saw over the last 15 years was the Chinese government just plowing money and incentives into electric vehicles. And as a result, China has become by far the dominant player in global EV markets. China sells 50 to 60% of the EVs that are sold globally in any given year. In the United States, we're trying to catch up, but we are really lagging behind. China sells about a third of their vehicles that they sell in China are electric. Europe sells about a quarter electric vehicles today. And in the US, we sell under 10% electric vehicles. And so there have been very aggressive efforts by the Biden administration and by the Democrats to promote our EV industry through things like the Inflation Reduction Act. And I think one of the biggest risks is if there is a change in administrations, if, for instance, Donald Trump were to become president, you would see the rollback of a lot of Biden-era policies that are looking to push electric vehicles in the United States.
So Levi, let's talk implications then. As we look at the elections, the potential for either former President Trump coming back or the Biden administration staying in, how would we see that play out for a company like Tesla, given the tax incentives, but also being that we're seeing the big three US automakers also pulling back as they had to sort of make up for some of the costs they incurred after the UAW strikes?
So you'd see it all along the value chain. And, I think it is important to emphasize just how transformative the Inflation Reduction Act has been for the US EV market. It's catalyzed well over $100 billion in investments in EVs and EV adjacent spaces. And that's because we're subsidizing every single step of the value chain. We're subsidizing the production and refining of critical materials. We're subsidizing the factories that are used to build batteries. We're subsidizing the production of batteries. We're subsidizing the sale of electric vehicles, and then we're subsidizing the sale of used electric vehicles. And after that, we're subsidizing companies to take batteries from electric vehicles and either repurpose them or recycle them. And perhaps most importantly, we're also subsidizing the infrastructure to charge electric vehicles. And so there is a huge wave of policy support that the EV industry has the potential to ride right now and get back in the race with Europe and with China. But if you see a change in power in Washington, if Republicans take over the Congress and if the Democrats lose the White House, we could see a lot of these policies rolled back. And there are different ways to do that. You can pass legislation, or you can just use the administrative levers of government to slow down or reduce the efficacy of a lot of the laws that were passed over the past couple of years.
So, Levi, in order for some of these companies, especially US companies, to sort of regain some of that dominance, what is it going to take? Is it about innovation in how we charge, whether it's swappable batteries or the infrastructure itself or the software? What is going to be the key driver here to get the US back on track?
Well, we do have some very good auto companies in the US. And I think if you're taking a global perspective, Tesla is by far the most global of EV producers. Tesla has a relatively diversified market. They sell a lot of EVs in the US, but they also sell a lot of EVs in China, about half as many by value as they do in the United States. And they have a significant market share in Europe as well. I think one of the big challenges for the United States market is that we just don't have the infrastructure to support electric vehicles. And that's not just about building new fast chargers. There are a lot of challenges to public infrastructure in the United States. Right now, the companies that are out there that are pure plays in EV infrastructure, they're not making money, they're losing money. And quite frankly, the public charging experience isn't that good. Half of the time you roll up at an EV charging station and either you or the guy next to you can't charge because the charger is broken. And even when you can charge, it still takes quite a while to juice up your electric vehicle. So for me, I have a Ford Mustang Mach-E, and it takes about 45 minutes to get from 20% to 80% charge on a good day in that EV. And so I think really figuring out what the solutions are to these infrastructure challenges is going to be a big part of EVs becoming a major part of the transportation story in the United States going forward.
Well, I know that you do have a reliable Tesla, and of course, I'm talking about your dog named Tesla. Shout out to him. And thank you for joining me this morning, Levi Tillerman, author of The Great Race, The Global Quest for the Car of the Future. Great to see you. Thank you so much.
Thanks, Rochelle.
All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. President Biden's $400 billion green bank might be on the chopping block. Congressional Republicans are investigating the Energy Department's lending arm. Yahoo finance reporter Rick Newman is here to break this down. So, Rick, set the stage for us here.
Well, everybody in Congress remembers Solyndra, which is an energy company that the Obama administration funded through a $535 million loan from this Energy Department lending program back in 2009. And that ended up as being a poster child for what can go wrong when the government tries to fund private companies. It went bust in 2011. That was a lot of taxpayer money down the drain. And there was some evidence that company did not deal honestly with the Energy Department, and that the Energy Department had poor oversight. So what Republicans are now trying to do, now that President Biden is back in the business of really trying to ramp up green energy and resuscitate this lending program, is they're trying to find another Solyndra. They're trying to find another glaring example of a bad loan issued by the Energy Department. And in a way, this sort of parallels the so-called Biden impeachment effort in the House, where they can't really say Joe Biden did anything wrong, but they're starting an impeachment proceeding anyway to see if they can come up with something. So this seems to be what this committee in the Senate, led by Republicans, is trying to do. It's trying to figure out if they can find any problems in this Energy Department, which has ramped up again under Biden after several years of dormancy following the Solyndra fiasco. So we'll see. I mean, it's certainly possible that something is not going right in this program. It's not always the best move when the government puts a lot of money into the private sector to get businesses going that cannot otherwise get that financing, which is one of the things here. So maybe they will turn up something, but I think really important to point out, this is one of the reasons this program exists, to help fund innovations that maybe cannot get private sector financing and might otherwise not get off the ground. So to some extent, there should be a little bit of failure in this type of program, but that is not cool in politics.
I mean, and you figure we're in an election year. Obviously, everyone looking for something, the potential for a government shutdown, also potentially in February as well. Do you think this is going to affect President Biden's approach to this? Have we heard any sort of response?
I think it completely depends on if they find anything. So I think the Solyndra debacle back in 2011, I think that did damage the Obama administration and its efforts to push green energy. That was a much smaller effort than what Biden is overseeing, but it was a pretty big deal at the time. Now, Obama did win re-election in 2012, so it's not as if Solyndra just completely derailed President Obama's political career. It did not, but it was a bit of a black eye back then. And you know, sometimes these congressional investigations, I mean, these are fishing expeditions, but sometimes they do turn up something. And the one that comes first to mind is the House investigation into the Benghazi incident in Egypt when Hillary Clinton was Secretary of State. That ended up turning up information completely unrelated to Benghazi about Hillary Clinton using private email server instead of the government one she was supposed to use, and some other things involving her private server that arguably did damage Hillary Clinton when she was running for president in 2016. So it is a fishing expedition for sure, but these things can turn up stuff that makes a difference.
Indeed, we've certainly already seen that happen as we look at what's been happening with former President Trump as well. Appreciate you joining us as always. Yahoo finance reporter Rick Newman. Thanks so much. Well, 2023 was a lackluster year for global startup funding, falling to its lowest level in 5 years, according to a new report from Crunchbase. But how much of this falls on the regional banking crisis, or are other factors spooking investors? To break down the numbers, Janae Tier, Crunchbase News senior data editor, is here. Thank you so much for joining us this morning. It's tough because it feels as if there was this very high bar in 2021 for this sort of funding. So put this in context as to how 2023 went and the expectations for 2024.
Sure. So, Rochelle, great to be here. So I think it's no surprise that venture was down in 2023. And this is the first year where the whole year was down. It was around 285 billion, a 40% decline year over year. And if you look at the market peak in 2021 was around 600 billion. 2022, earlier on in the year, Q1 was still strong. Q2 venture started coming down. That was north of 400 billion. And this, as you said, is the lowest we've seen in the last 5 years. So a very slow year for the venture equity funding environment.
And Janae, which aspects have really seen the greatest inflows in terms of venture capital, and which ones have you seen the biggest pullback on?
Yeah, so we've seen the biggest pullback in, across the board, most sectors were down. What was interesting to us is that financial services is a huge sector. There's a lot of interest in financial services and digital payments, and that was down 50% year over year. And then we saw a lot of consumer also down. So we saw e-commerce was down significantly, I think over 60%. We also saw media entertainment down significantly. So a lot of the consumer sectors, but most sectors were down, including Web3, I think was down the most. This is cryptocurrency and blockchain. That was down more than 73%. So real fall off in Web3 funding.
And of course, we've been talking about AI for the better part of more than last year. But as you look at the sort of spending, how are companies really viewing this? What are they looking for when they're trying to put some investments to work on something, especially generative AI, still very early days for this technology?
Yes. And so I think AI was the one bright spark. I think it is the sector which has sort of excited the whole venture industry. That is an industry that is going to, generative AI is going to play out over the next 2 to 5 to 10 years in venture. And so I think this was the one area of excitement in the industry. And we did see that industry go up, where it was around last year, it was around 46 billion went into AI. This year it was 50 billion. So not a massive increase, but an increase nonetheless, and it is an indication of the excitement. And we've seen a lot of those dollars go into those foundation model companies. Around 18 billion went into the top 3, including, OpenAI, Anthropic, and Inflection AI. We saw a lot of dollars go into machine learning operations. So it's sort of managing your AI workflows. There was a lot of money there. And then there's a lot of interest in how that plays out on the application level for consumers, where consumers get the benefits. So we looked at, Figma, Adobe. There are lots and lots of consumer plays in AI, and those tend to be incumbent companies who are adding AI into their stack to provide productivity or better solutions for their business and consumer users.
So, Janae, when you look at the sentiment then, especially being led by AI, what does that mean for the broader market?
I think what it means is, what's driving this sort of downturn in venture is really the lack of liquidity for the venture markets. So when the public markets slowed down at the end of 2021, we saw a lot of tech stocks pummel at the end of 2021 and into 2022. And then very, very few venture-backed tech companies have gone public since the beginning of 2022. So we've had 2 years of a real slowdown, and that has really put the brakes on the venture community. As I said, it takes a little time. So the first 2 quarters of 2022 was still up. But since then, because we've had so little liquidity, we've seen the whole venture community step back. And I think what's been interesting, it's not just late stage, those companies who are going to be entering the public markets where the cutbacks happened. It cut back at late, then it cut back at early stage, and then it cut back at seed. So absolutely every single part of the ecosystem is impacted by the slowdown. It's trickled down to every stage.
And it's interesting, though, because on the flip side, also a general sentiment of bullishness that you note when it comes to IPO expectations for this year. So talk about what's driving that. What are the factors then that are driving this IPO optimism, especially given we haven't really seen the best performance coming off of last year?
Yes. So I think what was interesting is 3 companies went public in September. These were the strongest tech companies to go public if you look out over the last two years. So there were Arm, which was SoftBank owned, so not venture backed. But then we had Klaviyo, and we also had Instacart. And both Klaviyo and Instacart are down from their IPO price, so there is a little dampening. I think what I've heard in speaking to analysts is that there are companies who will continue to test the markets in 2024, but the expectation at this point is that 2025 is possibly going to be a bigger IPO year. So I think we will see companies go out in 2024. And if there is a bump in IPOs in 2024, that will definitely lift the venture markets. But it's still to be seen. We're not sure if there is going to be a big bump in 2024 yet.
And certainly a lot of people waiting to see what the Fed does in 2024 as well, sort of hedging their bets there as well. Appreciate you taking the time to join us on Yahoo Finance. Janae Tier, Crunchbase News Senior Data Editor. Thank you so much.
Thanks, Rochelle.
Now to some breaking news. The Federal Reserve Bank of St. Louis has a new president. The central bank naming Alberto Musalem as its new president and CEO. He will assume the role on April 2nd. Musalem is replacing current St. Louis Fed President James Bullard, who resigned from his role in July of 2023 after 15 years at the helm. Bullard is leaving for Purdue University, where he'll become the dean of the business school. According to the Fed, Alberto Musalem has more than 27 years of public and private sector experience in economic policy, finance, and markets. Musalem saying he is, quote, deeply honored to serve as the next president of the St. Louis Fed and grateful for the opportunity to promote a strong, resilient, and inclusive economy. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance. CVS is cutting ties with AbbVie's Humira. The healthcare giant announced starting April 1st, it will begin offering less expensive alternatives. Yahoo Finance says Anjali Kemlani has the details. Hey, Anj, we knew this was coming down the pipeline at some point.
We did. And it's important to point out that it is more of a shift in strategy, if you will, on the part of CVS. While it is cutting AbbVie's Humira off of its national template for formulary, it isn't necessarily doing away with it entirely. But let's get to the basics of what this is. This is going to be in effect as of April 1st of this year. Humira will be replaced with all the other biosimilars that are out there that CVS is contracted with. The FDA has approved about 9 to date, and so we'll see which ones really make the list. And in addition, CVS is expecting a co-branded version with AbbVie out in the second half of this year. In addition, CVS already has a co-branded version, co-branded biosimilar with Sandoz. So really, CVS taking on an interesting role here. We know that they launched Cordavis, their generics arm or biosimilar arm last year, and this seems to be sort of CVS pushing forward with that. But it's important to remember that this is not necessarily doing away with access for Humira entirely. In fact, AbbVie already worked this into their projections for this year. It's already been worked out. JPM's analyst Chris Schott earlier saying that they note that there's a subgroup of the commercial formulary still having parity access to the branded version that includes employers, unions, and health plans for prescription coverage. So it's not all going away. It's just certain parts of the commercial market.
Well, certainly, at least some relief for patients perhaps looking for a cheaper alternative. I know Humira is expensive. Appreciate you breaking that down for us, our very own Anjali Kemlani. All right, well, that does it for now. A mixed picture for markets at the moment, but Yahoo Finance will stay with you after this break.